All right, good afternoon, everybody. Welcome to tonight's event, Long-Term Trading, Investing, Review, and Analysis. As usual, I have overpacked the evening as I ran through these slides, so I'm going to just kind of get going here right away. Quick little hello to some of you. Over time, some of you come and join us from wherever you come from, and you may not know me all that well. So let me just say hi to some of you who maybe have been here your first time or first time this last month, and just quickly say hi. I'm Paul Lange, and if you've heard my name, I've been in this business for like a long time, longer than I care to say, let's say. And I worked a long time for Pristine, and always kind of contemplated going off on my own because there's a lot of huge negatives about working for a company, but there's also the huge negative of working, having to do all the hassles and running your own business. But these days, all the modern technology, it's not much of a hassle. So I've been having a lot of fun. It's been great. And I really have just had a goal before I retire here to take a few years and to help people who want to learn this stuff. I'm laid back. There's no sales team. There's nobody ever calling you or bugging you. And whatever help you need, I do three things basically. I personally, I like day trading, long-term investing. So I have a day trading room that's mostly active the first couple hours of the day. I have a long-term trader letter. It's a letter you receive for long-term investing. And I also teach all of this for anybody who wants to learn. So that's what I do. That's what I'm about. Tonight's event is going to be, like these all are, these are very information-packed type of events. And so as not to disappoint, I do want to make it clear, I'm not trying to teach like a seminar here. The information you need to learn to read a chart is something that you have to be serious about if you want to learn it. But nevertheless, the information here, I actually require my seminar students to attend these because there's really good information here that's kind of peripheral and things you need to know still. So tonight's focus is on long-term trading, investing. And there's going to be a lot, I think, of really good stuff for you to go through. So let's hop right to it if you don't have any questions. Oh, one other thing about me. Today, it's just going to be a lot of common sense for today, but I've come to realize a lot of times when I think something is common sense, sometimes other people think it's rocket science just because I've been doing this for the last half of my life, and a lot of the stuff is just second nature. So sometimes they take for granted or forget that some of the stuff is not necessarily common sense. So everything we're going to talk about tonight, I think, is from a common sense point of view. I'm not here pushing anything on you at all. It's just information. Feel free to ask questions. And I also want to remind you guys of something as well. Let me ask this question for fun. See how, if you take seminars with me, don't answer this question, but let everybody else answer. Me personally, by naturally, what I teach is what we have to do is we have to follow charts to be bullish or bearish. But I think everybody by nature has a certain inclination. Do you think that I'm by nature kind of a bullish or kind of a bearish person? Take it and don't type a B. Everybody else types a B. That doesn't work because B's kind of go both ways. B-U-B-E. What do you think? Bullish or bearish? Take a guess. Just by nature. I think everybody has this by. I know everybody. Everybody does by nature. I don't care how good you are at following charts and how well you do in the market. I think by nature you have this gut. You know what it is. Yeah, I am by nature. I'm very much a bearish person in the sense that some of you look at the market and you say the market's nuts. I agree with you. Market is nuts. Market's overvalued. Oh God, yeah. I sold a business. How many of you ever sold a business? Give me a one real quick. How many of you ever sold a business? Okay, what did you get? I sold my business for about a 4 earnings, a 4 PE. What did you sell yours for? I sold mine for about a 4 PE. Maybe it was 5. About a 4 to 5 PE. 15. Wow. Well, it's meant like in tech or something very transferable. 3.5. Yeah, right. So to me, do you know how insane it is to me when they're out there talking about PE ratios? Like if you're some kind of fundamental trader, and this is all the more reason why fundamentals are completely worthless to look at. They're talking about, oh, well, now that we've gone from an 18 to a 22 PE, the market is overvalued. The market is overvalued at any number. These are all just make-believe numbers. Do you guys know? I mean, I know you do, but think about what it means. If you sell something, if you owned your local donut shop and you sold it for a 22 PE, do you know what that means? It means that the buyer of that donut shop will have to take all the profits he makes for the next 22 years to pay back what he paid for the shop. Would anybody do that? Yes. Would anybody do that? Would anybody wait 22 years to get their investment paid back? Well, price earnings. In other words, if your business took in $500,000 of profit and you sold it for a 5 PE, you'd sell it for 2.5 or whatever. But that's the fundamental numbers you hear all the time. I mean, if you ever, I mean, you can't listen to a show like CNBC for more than 30 seconds without hearing the name PE. It's price earnings ratio. And these are when you try and trade fundamentally, these are all the great numbers they throw at you. And of course, based on that, the market was oversold 9 years ago, literally, 9 years ago. Anyways, and I got Eric going on donuts here. So there's some quick things on me, just so you know, because I just want you to understand as I go through this and I show you, how bullish I've been. It's not because it's not because I'm just bullish. I'm not one of these idiot permables that just is going to be long until the market falls apart, then lose everything. That's not at all what I do. I don't lose money on the short side. It would be very hard for me to do that because if anything, I'm a little too quick on the short side. Discussion points. Big picture comments about your money investing. Where's my little red ball? Big picture comments about your money investing in the future, how to handle long term, the role the market should play, the review of the last year long-term trader trades, blah, 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 chart examples, blah, blah. All right. Just a reminder, coming up Friday is the Introduction to Mastering Technical Analysis class. This is a required class for seminar students. It's also open to everyone who's here listening. All members get to attend the Friday class for 4 hours. I suggest you do. It's a lot of good information. And then Saturday starts the actual seminar program. Saturday starts the paid for classes. So people are always emailing me Friday night asking me for the login because they think that's part of the Friday class, but it's not. First, terminology, just so we're clear before I proceed here. I use the word trading for everything, okay? I don't really care what you call it. Words are just words. But I call trading because trading is a style. It's not a time frame to me. Trading means you have defined entries, stops, and management, which right there is a reason you can't trade fundamentally because you don't have entries, stops, or management. You have the SOYP method, seat of your pants method. You don't have that with any concept of fundamental trading. And selling at a 7% loss, the reason I put that in there is because there was a while back where everybody was so enthralled with Investors Business Daily, and they had these rules. And anybody remember this? And one of their rules was, when you're in a position and you're down 7% of your equity, you get out of the position. What do you think of that rule? What do you think of that rule? Remember IBD something? You remember that? I remember back when this was just, boy, this is like on the news. It's like, wow, what a great outfit, what great intelligent thing to do. When you're losing in a position 7%, get out. What do you think of that? A big group, but a quiet group, I see. Yes, stupidest thing I've ever heard in the world. You're going to be down 7% before you react to it. It's just, yeah, exactly. It's just ridiculous. I mean, you have to be a little better than that. I'm not against, of course, getting out of positions when they go bad. But first of all, 7% move in the stock really has nothing to do with your position in the stock. Your position depends on how you got in, and good traders, a 7% move in the stock may be making you it may be half of your portfolio. It may be half of your net worth. I mean, it could be a huge move. It depends on how you got into something. 7% is just a ridiculous concept. So we have to do better than that. So trading is a style and it's used on all time frames. Day trading, for example, is when you're using intraday charts to make money and you're buying and selling throughout the trading day. To do that, you have to have a day trading account and you have to be able to have the time to sit there during the day. Swing trading, typically that term is used, and again, it's just a word. I don't really care what you call things, but it's typically used the concepts on daily charts when you can't be with the market during the trading day. It's a very popular but typically a very bad idea. I'm not going to ask for a survey because you guys are too slow tonight, but typically speaking, I would wager that if you are swing trading and you work during the day and you're coming home and looking at daily charts to use your entries and that kind of thing and calling them in the next day or putting orders in, you're probably historically been struggling. You may be okay this last couple months because things are vertical, but you're probably really struggling. Swing trading to me is one of the absolute most difficult, worst time frames. I don't swing trade. Now, if you can swing trade by being there during the trading day and swing trade using hourly charts, I think that's a very good thing. But it is not good to me to be swing trading from daily charts. As a matter of fact, there is a video I did about that, and it's on the free stuff page. I imagine most of you know where that is. And it's in, I forgot what it's called. You'll find it. It's in a section with only 3 or 4 other videos. And the other term then for longer, you've heard the term core, would kind of equivalent what I call intermediate. I kind of say, intraday, intermediate, long term. Those are the 3 time frames you look at. The word core kind of means that intermediate time frames, looking at weekly charts maybe, and then long term, looking at weekly and or monthly charts. And this is also what you may just call investing. If you want to call it investing, fine, just so we understand that it's never the buy and hold concept from days gone by. So I just use the word trading, long-term trading. Don't think that that means it's short term just because I say the word trading. You could have a long-term trade go on for months or years or whatever. All right, let me get to this next one here. Bigger concept. Let me hit on something called financial planners. And there's 3 reasons I want to talk to this. Number one, this is not my area of expertise. I'm not a financial planner. I'm not here to be your financial planner. But number one, because I've picked on mutual funds, brokers, market analysts, pundits, people have asked me if I have that same negative view of financial planners. And my answer to that is no, not at all. Financial planners are very, very different people. Financial planners are actually very, very good things in general. Before I even get there, though, before we continue financial planners, back on this slide, it said that I'm not a fan of mutual funds and some other things. And the reason is because they don't help anybody. They don't do anyone any good. For example, mutual funds. What's wrong with mutual funds? I need a sip of beverage. I'll ask you guys that question. What's wrong with mutual funds, everybody? Sounds like a good idea. I don't want to learn the market. I need to do something with my money. Let me give it to a professional and he'll make money for me and I'll pay him a small fee for that. And it sounds like a good plan all the way around. We all win. What's the problem? Yeah, well, even prior to fees, the pure fact of it is, and again, I don't like or dislike anything just subjectively. I like or dislike things objectively. I don't like them because they don't even beat the market. This is a recent study. This is 2016 S&P Standard & Poor's in-depth research project. You can read the article. It's right there. And basically it says 93% of funds do not beat the market. And actually that is even a worse ratio if you get outside of the main funds, if you go into small cap funds and that kind of thing, right? And the other thing that I want to get into today also, because it's going to become a very important thing over the next 2 to 12 months, 2 to 18 months at least, is that it's not just a matter of, gee, did it keep up with the market on the way up? The other issue is, what about when the market's not up? What's going to happen then? The stated goal of mutual funds is to try to lose less than the market. Again, I consider that to be insane, just absolutely crazy. Why is it that funds are so bad? Some of you already answered the question. Why are funds so bad? Why do they do so bad? It's not necessarily because the people running them are poor. I'd hate to have to run a fund because they're too big. Why are they bad? Because they are huge. They move the market. They have billions of dollars of money out there, and when something runs up to a point, they can't get out for free. They start a big move back in price. They're not nimble. See, we can be nimble. I'm going to bet there's nobody listening to me that has to plan how to sell a long-term position because they're going to move the market. Not unless you're trading in some stock that trades like 2,000 shares a day, right? So this is where we have the big advantage. I mean, we can, anyone listening to me, I'm sure, could sell their entire position in any stock and not even make a blip on the chart, right? Or if you did, it'd be a very small blip. If you're up $10 in a position, you could sell it and not move the stock more than a few pennies. So we have that huge advantage that we don't have to try to get a decade-long move to make any money. And that's a big deal. Bigger. So back to financial planners. Financial planners are good things. And again, I'm not a planner. I'm not here to teach you that. This is not my area of expertise. But it leads into something that's very important in my view. And I hope you all, take this the right way, whatever. There are some bad financial planners that are just glorified salesmen. Most of you probably know this. I'm not telling anything for new, but there are some that work for companies and they just have a certain product, an annuity or whatever, and they just throw everybody into that and they're just making commissions, and that's not what you want. You want to go to somebody who's a real financial planner, and ideally somebody who also is a tax accountant at the same time. Paying for someone's time who can help you plan your financial future based on your age, your income, your tax situation. You may also choose to figure out for yourself, but if you do, don't overlook the tax situation. It's very important. You may struggle to make 1 or 2% more on your investments, but that pales compared to cutting your taxes in half. So make sure that you're not, penny wise and pound foolish and trying to save money where you could be making lots. So I think they're good people to go to, but here's the issue that you're gonna get to. And again, I want to keep saying I think financial planners are very good people, but I want you to be aware of something because there is a negative to it. This is what, typically speaking, a very simplified financial plan is going to come down to for everybody, right? Everybody's so old, and the older you are, the more this shifts a little bit. But what the financial planner is going to want to do is to set up a basket. I used a safe here, but a basket of money that by the time you're ready to retire is going to be enough money that at fixed income, meaning at a fixed interest rate, by buying, by buying bonds, maybe municipalities, whatever, that the money you have at that low interest rate plus your Social Security can pay for the life you want when you retire, right? That's the goal. And then once you have that money stashed away, then anything else is extra, and you can play with it, put it in risky things, right? Well, what's gotten to be a little bit of the problem with that today, in today's world? What's the problem with this? People who say over the last 20 years have been looking to go to get close to retirement or something. You're in your middle, early, and now you're getting older. What's the problem? What kind of happened? Iran, North Korea? What do they have to do with anything? How has Iran and North Korea affected anything in the world? I don't understand. Yeah, low interest rates, right? Does that matter to you? Well, it does. It matters huge. I mean, this is just kind of common sense. There was a time, now somebody told me one of these things that they swear to me they had an 18% CD. Now I remember I was too young. I'm not saying this to brag, but I was too young to really have anything. I didn't back then. But I remember seeing at my bank a 15% advertisement, meaning for those of you that are really young, you may not even understand what I'm saying. You could walk in your bank and make 15% on your money. You'd be tied up for 3, 6, 12 months, but you could make that on your money. Yeah, in the mid 80s, exactly, when interest rates were off the chart. Your mortgage was also, well, there was a time you couldn't even get a mortgage, basically. That's when I went to buy my first house. I had to buy it on a contract sale because interest rates were, I think, 16% or something. My first mortgage was 13%, and I was happy to get it at 13%. They just came down. Then, then they went to 8, 10%, and what is it today? Well, it's not much above zero, right? Does that make a big difference? Well, if you've been planning kind of that you're going to put this money away, and let's say you have $500,000 and you're making 15% on your money, well, that's $75K a year plus your Social Security. Okay, I'm comfortable with that. $500K at 2% is $10K a year plus your Social Security. Well, now we're talking, trailer park. Not that there's anything wrong with the trailer park, but we're talking trailer park is probably the top end of your scale. My grandmother, you did? Okay, all right. Well, the free toaster is what does it. I mean, the free toaster would get me there. I mean, if my bank offered me 18% without the toaster, I don't think I'd take it today. But 18% plus the toaster, yeah, okay. So I believe you guys. That's wow, that is hard to believe. I remember seeing 15. That's all I can swear to, but that's amazing. So you see where the problem comes. Now, what does this problem lead to, real quick? I'm already slowing up like I always do. What does this problem lead to? What does this problem lead to? It leads to a twofold problem for everybody. For everybody. Especially if you're, in middle age or past. What's the big problem? If you're middle age or past, You've got this gnawing at your brain every day, or maybe you don't care. All right. The problem is, right, you're not making it, right? So you have two choices. What are those two choices? Well, number one, your financial advisor will tell you what? Your financial advisor will tell you save more money. Well, that's a good answer, but guess what? Not everybody likes to or can just suddenly save more money. So the other option that people turn to a lot of times is more risky investments, right? Financial planner's not going to like that. Not going to like that at all. But this is the dilemma you're left with. Now, here's where I want to get to, and the reason I kind of went down this whole road in the first place is that while financial planners are good and I like them, financial planners consider the stock market a complete gamble, and and they should, financial planners. Why? Because financial planners, their only knowledge of the market is to just say use mutual funds, right? They will say that the market cannot be timed, but it can be timed, with only one exception. I'll tell you in a minute. It does not matter because you really don't even have to time it very well, and the market can be very safe, but not the way your advisor or most people would tell you to do it. There's a very big difference. And the biggest issue, which I'm going to get to here in just a second, is that most people consider the market to be kind of an all or nothing thing. You take your money and, okay, let's time it, and all right, let's get in now, right? And when do people get in? They don't get in at the right time. And then you're down 5, 7, 10%. What do you do? And this is why people struggle all the time. Remember this, that in a very real sense, financial planners compete with the market. Does that make sense to you? Financial planners compete with the market. Does that make sense? In other words, if the market were a piece of cake, financial planners would almost kind of not be needed, right? If everybody could go make 10, 15, 20%, the need to have somebody try and plan this out would be greatly diminished. And you hear it every single day. Here, let me pull the slides up here. If people were good at the market, the need for financial planners would decline, at least the perceived would decline sharply. See, a lot of times there's a difference between the truth and the perception. And the perception would be, hey, making money is a piece of cake. I don't need anybody to help me with this. And then when you start struggling, you look around, you say, hey, how do I make more than 2% of my money? I better talk to somebody. But what you hear from advisors all the time, and I love this all the time where I am. I don't know if it's true with all of you, but I hear commercials all the time. We have a couple of big financial planners here, and they're on the radio all the time. And this is the things that they say. You can't afford to live through a correction. No one can time the market. Experts are warning a crash is imminent. And by the way, I heard this warning 8 years ago. No joking. 8 years ago, some of you may not know the history, but when we came off the lows in 08, 09, the market doubled fairly quickly. The market tripled in a year. You know what everybody's saying? That's it. The market is so overbought, so incredibly extended, that that's the end of the market. Yeah. Well, I mean, as time goes on, it makes a little more sense, Steve. But can you believe that, though? I mean, that was 9 years ago. 9 years ago. So, and then you'll hear, look how much the market is up. Do you think that it's better to get in or to get out? And by the way, don't get me wrong. Coming from your financial planner, these lines are correct. And if you don't know any better yourself, then listen to them. I would not tell anybody to go put your money in the market today. Not at all. But you know what? I am almost fully invested myself, right? I mean, I'm close to, I consider for the people in the letter that follow me, I think it phrases in there that 6 to 8 positions would be max investment, and I have 6, 5 are long and 1 is short. But I wouldn't start doing them today. And we're going to talk about the important part of this is really going to be at the very end, so don't cut out early, but kind of how you go about doing that if you want to do this on your own. So for financial planners, it's not their area of expertise. Every day I hear the commercials, and the financial planners, they're always kind of battling the market, because they're always, to the extent that they could say to you, the market is extremely risky, it's extremely dangerous, you can't be in the market, that turns clients to them. Does that make sense? And again, I'm not knocking them because they're kind of right. The market can be very dangerous for people because the way most people do the market, it is completely wrong and it is backwards. But the thing is, the financial planners don't understand or know how to do the market properly. And that's what I want to get across to you. every financial advisor will either have you out way early, and I'm talking years early, or will never have you out. I don't know how young you are, but waiting 17 years to get to break even is not okay. 1999 to 2016, 17 years to get back to break even from the crash of 99. So let me explain. Let me explain, Lucy. Number one, the market is timeable, although this is for the more advanced chart reader. Now, I'm talking to you from two perspectives. You may want to learn how to do some of this. You may already kind of know how to do some of this, but I want to kind of guide you through. If you want to just do better on your own, what are the guidelines you need to understand? The market is timeable, excuse me, but this is probably the pinnacle of success as a trader, because if you're just looking at saying, hey, I want to be in just the market. I want to buy the stock market, period, and I want to know when to get in and out. That is the most difficult pinnacle thing to try and find. I a lot of my success is through the fact that I use stocks as kind of what I call a buffer, and I'll explain that in a minute. But nevertheless, it is very doable to find the tops and bottoms in the market, and I'll go into each of these in just a little more detail. You never go all in and go out. You never do that. You never just back up your account and say, okay, time to get in the market. That is insane. And if you don't do that, the need for number one is greatly reduced. You always only add to a winning portfolio. You never average down or average up if you're shorting. And you use unique stocks as a hedge. Let me explain what these four little secrets are, which are really kind of the gut of tonight's talk. Are we okay? You guys with me? Before I proceed here, we good? Understand everything? Know where we're going? Nobody's lost or anything? All right. Not that this has been complicated, but all right. I will review each one of these with you, but it requires that you either know technical analysis or follow someone that does. Okay, so here's the point where I'm not trying to kid you. I can't just read these slides to you and you're going to know how to do it necessarily, but I want you to understand what you have to know to be good at this. All right. So number one, the market is timeable, although this is more for an advanced chart reader. Now, this is not about me sitting here and going over 55 calls from me for the last years, but many of you know me, you know this is true, you get the letter from me, whatever. This is how I always break things down. The intraday outlook, which is the day trading outlook that changes every day. The midterm outlook, which is, the next kind of several weeks, maybe several days, depending on where we are. And the long-term outlook. The long-term outlook for me has been pinned to max bullish for 11 years now. Now, I've only been doing this letter at DTS since I started the company 2.5 years ago. It's been right there, never touched the entire time since this letter started. But also before that, when I was doing a similar thing at another company, it was always max bullish ever since I got the low coming off of 2009. Midterm outlook moves back and forth, and I want to show you an example of that. As a matter of fact, that's next. Midterm outlook, can you predict what's going to happen? Well, awfully accurately, yes, you can. And I just want to show you this most recent. Here we are. This is today's chart or yesterday's, whatever it is. And right here, you see this big grinding move. I call this a power trend, where the chart is, this is a daily chart of the market, it's the QQQ, but it is so tight, there's this one little exception, there's a little dip here, but it is so tight and precise, it's not even really giving what we call setups. It's not like it's doing its normal kind, ebb and flow where it goes up and goes down, you normally see market do that. It's not even doing that. It just simply is grinding higher every single day. Could you predict something like that? Well, in the letter, on November 4th, which is that day right there, we're going to enter, here's a very common pattern. We're going to see the market gap up a little to medium amount every single day and then go sideways for the day. Smaller gaps will leave small green bars, large gaps will leave small red bars, and we'll continue this in the daily chart. We'll continue to grind higher. That's back on November 4th. That's 2.5 months now we've been doing that. So it helps you very much to help you understand what to do. For example, I made sure I was kind of maxed out long as we got into this, which I was. I had one long position from before this, and then I went kind of crazy here. And they're all working out okay. The number two, you never go all in or all out all at once, and then the need for number one is greatly reduced. This is simply crazy and leads to a deer in the headlights type of reaction. In other words, what happens is to people, but if somebody wants to volunteer and type like a 1 on the screen and say, yeah, Paul, it's exactly what has happened to me, or it used to happen, or I can relate to it. But here's what happens to so many people, why they hate the market. They decide that this is a breakout of some kind, right? And they get in. They get all in, right? Well, what happens? What happens is maybe it goes up a little bit, they don't sell anything, and then boom, they're down 7, 8, now they're down 10%. See this red bar? They're down 10%. What do they say? What do they say? Down 10%. Can't take it anymore, right? I'm out. I'm done. And of course, you know what happens, right? The day after this red bar, we just go up, right? Yeah, whatever rule. And even if you're not following a rule, you just hate the market because you're getting in on your intelligent entries on new highs, which of course is usually stupid to do. And then you're getting out at the lows and you keep looking back. It keeps happening to you all the time. And this is where people mess up a lot of the time because number one, they don't really know where a possible good spot to look for lows and highs are on the market itself. And then number two, they're just piling all in so that unless they go straight up, they're in pain from day one. And you don't often go straight up from day one. Only add to a winning portfolio, you never average down. It is just crazy to do otherwise. In other words, here's a bullish market environment. We're in a nice uptrend here, right? So you jump in and boom, you get killed. What do a lot of people do? I'm sure nobody listening to me does this. What do a lot of people do right here when that happens? They're down 3 times the amount of money they intended to be down. Yeah. We've been in an uptrend, and this was coming off a big uptrend, right? We've been in a big uptrend. This is the going into '08, right? Right. So they decided to, well, not averaging in is okay, right? Averaging down is bad. Averaging in means you'd be taking very, very small positions with the expectation that that you don't care if you drop and you're always restricting your loss to a certain amount. So you get in some more, you're getting killed, you get in some more, you're getting killed, and you finally say, I give up, I'm out, right? You never do that. And what's funny is I had a guy once that came to me for some help, and this is exactly what he did. But you know what he did? He said, Paul, I never averaged down. I never averaged down. I never doubled down. But here's what happened. What he shows me was like he bought Intel here, so then he bought Cisco here, and then he bought Xilinx here. You know what I mean? It doesn't matter if you're buying 6 stocks that are all the same stock. You're still averaging down, right? It doesn't matter. So he got killed. He basically lost his whole account because during a downturn in the market, he just it comes from not understanding what to do. When you understand what to do, there's rules. And in a situation like this, there is not even a concept of playing long. There is nothing that would allow you to play long. In my book, the way I would teach it, I mean, we'd have to see other time frames to understand what's going on. But, right, seminar people, right, macro stage 4, there's no concept of being long. It's not when do you do it, it's not how do you do it, it's not one of your tools, right? Period. And that alone would have helped so many people during, the hard falls that we've had. Now, we have not had a hard fall on the weekly chart going back really to 2009. We had a couple little dips on the weekly chart they were only little dips. If you listen to the news, you would have thought that we were at levels below the 1929 market crash, but we actually were not. And number 4, use unique stocks as your hedge. This is critical. It's all about stock selection. Unfortunately, this is one I can't really go into because this is one that involves understanding how to read a chart. But what I'm saying here is that, and to me this is a big part of it, I'm going to go into a little bit more in the next couple of slides, but the idea is that if you're in an area where you think that we are now maybe going to go into an uptrend or whatever, is that you try and get a unique stock. And what I mean by that is that the stock that you buy, maybe it still goes up even if you're wrong about the market. In other words, the market takes another leg down, but your stock just sits there. You don't stop out your stock. Maybe your stock even makes a little money, right? Or the other way around. We're in a tremendous rally, right? And you don't short the market because, God, that'd be the stupidest thing in the world, but you find a stock that's able to fall before the market hits its top. And then when the market does hit its top, your stock makes a lot of money. These are the unique things that give you, to me, a big edge, a buffer, so to speak, where we're using the market and understanding it and trying to find those tops and bottoms, but we're finding them kind of by throwing a hand grenade rather than trying to shoot a BB gun at the exact second the market is trying to turn. Okay? Matter of fact, for example, give an example in my long term, which is in the long term trader letter that I send to people. I've had a short for a couple months. I've had a short position. It's JetBlue Airlines. It's still green. And we've had the most bullish market streak, right, in history, and I have a short, and it's hanging in there. Quick little summary. Financial planner, good thing for the big plan. Not always a good thing for a small plan. The market is not risky, at least not the way most think of it. You should decide how to handle the aggressive part of your portfolio. You should decide how to handle the aggressive part of your portfolio. You can learn what to do. You can learn how to make money in a market in a laid back manner. You should never get in trouble. A 7% stop loss is idiot speak. You should never be in that situation. But not everyone has the time to learn, which you may be busy making your money, and that leaves you with two choices. Either number one, you can just try it yourself. I'm talking about investing the more aggressive part of your money in the market. And again, I suggest go to a financial planner, and then you're going to have some money you get to play with, and he may have some suggestions for you, and he may tell you don't ever be in the market or whatever he tells you. But if you want to try it, you can try it yourself. If you've been trying it for yourself, you just have to be realistic and objective. How are you doing handling your long-term money if you're playing the market with it? Are you happy with the money you're making? If you are, congratulations. You have the best of all worlds. You're handling your long-term situation. You maybe have a financial planner that's helping you, and you're making the return that you want to see in your long-term money. That's fantastic. But many people are not happy. They're frustrated and constantly tense because they don't really necessarily know what they're doing. The second thing to do is to pay for a managed letter. Now, this is way different than getting into a mutual fund. The problem with a mutual fund is that, like I said, it's big, it's huge, and they never ever beat the market. But the other option is to take your own positions, do it yourself. You're not going to be subject to this thing where there's millions and millions of shares being bought and sold where you are, and just use that fund. And then the question is, of course, not fund. Use that letter as your guide to your buying and selling. Does it make sense to pay to have a letter sent to you? Well, it's a simple math question. It's not like it's something you should be talked into or not talked into. What's your account size? How much did you make last year? If the letter you're looking at makes, for example, if the letter you're looking at makes 10% and you made zero, it's just a math question, right? It's not rocket science. If you have a $30,000 account, then if you made $30,000, if the letter you were looking at would have made you $3,000, excuse me. If the letter costs you $1,500, well, then it's a smart decision because you made $1,500 and you do not have the heartache, the misery, the tenseness of trying to figure it all out. If you have a $60,000 account, well, instead of making zero, you could be making $6,000, less than $1,500, profit of $4,500. And naturally, I'm using a 10% return from a letter you're getting compared to you making zero. But you have to do the same formula. Maybe you made 10%, but the letter made 20. You do the same thing. If you have a $100,000 account, see, the cost of the letter doesn't go up. It's not based on a percentage of your account like a mutual fund may be, right? So no matter how much you have, if you make 10 grand now, well, you're $8,500 to the positive. Now, there is a certain negative, I know, to this concept, and that is that there's a certain level of pride or stubbornness that will stop people from wanting to do this. And I understand that, and I've, as you know, I'm an advocate for people to say, go ahead and try this yourself. And the main reason I'm probably an advocate for that is because I did that in the beginning. I thought I'm a really smart guy, and hey, I'll go do this. And by the way, not everyone is that way. I am. A lot of people are. But I've had, especially recently, I've had people come to me and just say, you know what, I'm very successful in my business. I don't know anything about the market. Show me what to do. Didn't even try at all. Just said, I don't know anything. I want to learn. That's really not me, to be honest. I know a lot of people are like that as well, that they want to give it a try. So that's why I have these sessions. I have all the free stuff out there. But at some point, if you don't want to do that, you have a choice then of learning it yourself through the seminar program, if not with me, with somebody, or to just pay for the fish, so to speak, to get the letter, and to just use that. So that brings me to the quick thing. I just want to quickly hit this. The letter, the numbers in for the letter, the DTS long-term trade letter for 2019. Profit, for those of you like talking in R amounts, was 23.9 risk units. That's 23.9 risk units. In other words, if you risked $1,000 for trade, you made $23,900. If you risked 2,000, you made 47. If you risked 500, you can do the math on all those. How do you determine if you don't understand what I'm saying? It means that whenever you take out a position, you don't take it out with a blank check to say, well, I'm just going to lose thousands of dollars. I don't care. You look at a chart, and and again, when I send the letter and a position, there is a stop loss there, and that stop loss is there, meaning you calculate your share size such that if the play stops out, if you have to exit it, you will lose your $1,000 or whatever amount that it is, right? This formula is, what we really rely on day trading, because you kind of had unlimited capital. In a longer term account, we also talk about percentages somewhat. So the question then is, well, okay, if you risked 1,000 per trade, how much money would you have had to have in order to be able to afford $1,000 risk per trade? And the answer to that question for this last year, for 2019, was you would have needed $84,000. Now that's assuming that you put it into a standard 2-to-1 brokerage account. It assumes that you took the money out and put it there as you needed it, but also you left it there. So this is not the average money needed. This is the maximum money needed. So your percent return does not. Now your percent return, of course, doesn't change. It doesn't matter if you risk 500, 100, 5,000. Your percentage was 28%. Period. Right? That doesn't change, because both your base and your profit would change correspondingly. But if you risk $1,000, the max money you need, and again, that's the max, not the average. So if there was a period of time where there were 4 positions open, and it meant you had X amount of money, well, that then becomes the base for the whole year that you'd have to have out there. So that's what it did for this last year. Now, $500 is 11. Is that right? Yeah, it's 11,000. Yeah, I'm sorry. Thank you. God, I never would have caught that. It's a lot. It's obviously half of this. Yeah, thank you, Chris. Yes. It's half of that, obviously. Yes. Thank you very much. Darn, I thought I'd get through without a single typo. But let's talk about it. So, is that a good return? Is that a good return? Don't answer that. That's a theoretical question. Is that a good return? Remember when I do the Friday class, I ask you something. And I ask you, when I do that Friday intro class, I ask you guys, if you've been there, let's say I just took a day trade and I made $200 profit. Right? Jim, if you don't mind, just hold off any letter questions till I get through this educationally, and then I'll take anything at the end you want to talk about. Remember I said if you made $200 profit, and I asked, is that a good trade or not? Right? What was the answer to that question? Just took a day trade and made $200. Is that a good trade or not? Anybody remember the answer to that question? Right. It depends. Right? It depends on what you risked to make that $200. Right? And it's kind of the same thing here. I want you to think about this. You could say, okay, gee, Paul, you know what? The market was actually up more than that last year. That's what somebody would typically say to me, right? The market was up more than that. Okay, yeah, you're right. But to capture the market gain, what do you have to do? You have to buy the market on day 1, right, and hold it to day X, right? Isn't that true? You can't sell part of it. You can't buy part of it, right? You have to take all the money you're going to have. And in this case, it was $84,000. You have to take $84,000. You had to buy it on January 1st. And again, you may not buy it, obviously, on calendar days. But do you understand what I'm saying? That the only way that you could get the market return is if you held the market the entire time. Now, number 1, people generally don't do that. Number 2, what was your risk if you did that? In other words, the day you took $100,000 and bought the market, how much were you willing to lose? How much? Do you see the point I'm getting at, folks? The method by which this money is made is so much superior to just going out and buying one entity, the market. Am I making my point? Or at least do you understand what I'm saying? I'm going to make the point some more in a minute, but do you understand what I'm saying? I could not, no matter how well I know the market, I could not really effectively go out with the bulk of the account and just buy the market. I can't do that. It doesn't make sense to me. Because what if we start falling? What are my options? If you start falling, what are your options? It's either get out at your max loss or break your rules and try and hold. Buy the SQQ. Well, how's that going to help you? Just hedge it? Well, why don't you just get out? Why would you hedge it? Yeah, but well, as soon as you switch the inverse in ETF, then what if you do rally? Now you're losing money on both sides. I mean, yeah, I mean you're all saying flip. Do you understand what I'm saying? You're all saying just flip the trade, but okay. I mean, well here, it's not helping the situation, right? I decide one day I'm getting in the market. Boom, I get in, right? And the market drops. So I take all my money I have, and now I'm down 10%. I'm down $10,000, right? And your answer is to go short. Okay. So now I go short, and the market rallies. So now I'm down $20,000. Did you see my point? My point is you have no options of what to do. You're all in, and you either get your head chopped off or your success. Maybe you'll understand better if I go through and understand and tell you what you do. The point of this is I don't track this as a hard number, but throughout this entire time, and again, forgive me, is Eric here? Eric, you kind of follow the numbers pretty close. I'm going to say I was never down more than 2 risk units, like ever, right? In other words, when I was kind of started from zero a couple times, and we flipped from long to short a couple times, I've never, I'd have a couple stops, I'd get a winning trade, go up a little bit, couple stops, winning trade, go up a little bit, and then winning trade. So by kind of legging in by picking unique stocks, you're spreading it over time and price in a way that gives you a huge advantage. And I don't know if you can understand that well from what I'm saying. In other words, rather than just say, oh, boom, right here I take a unique long stock that I think is going to go up even if the market keeps falling. We drop a little more in the market, and my stock doesn't drop. Oh, cool. I take another position, right? Market drops a little more. Maybe one of these two stop out. I take another unique position. I'm still green out of my 3 positions. And then we take off. I was down 1.5 R 1 point, and now I'm up 5. Do you understand what I'm saying? At least conceptually, it's a big deal. And the point of this is that just to say, oh, okay, make that much, that's great, but gee, the market's this, the market's that. But you have to be in the market to make that. And when you do that, it's much riskier. As you get in and you start to make money, you start to maybe sell a portion. I like to sell in thirds. Almost all the time long term, I'm selling in thirds. So if I'm in a position and I sell a third, guess what? I'm kind of almost safe on that trade. In other words, I get in somewhere, boom, I get in a trade, and I sell a third. Well, guess what? Technically, I could still lose money if the 2/3 goes to a full stop, but the odds of that happening are very rare. Somewhere along the way, I'm going to raise the stop, and that means that position is now free, so to speak. I sold a third, and 2/3 is in the money. So guess what? I can go to the next position now. Well, I mean, again, you have to decide how many risk units you want. Usually, I have 2 or 3 that are floating out there that in my mind could be a stop in a bad situation. But when you get safe on something, you can keep adding. And you kind of roll into these things, right? No, not counter trend at all. No. Totally with the trend. Totally with the trend. But what I'm saying, Ray, is you can't always get the trend of the market to the day, right? Because number one, if you try and wait too long, you may miss it. You may just take off in a bullish market and you have nothing. Or if you jump in too early, sometimes it keeps pulling back on you. So I'm just saying that you have this buffer where, and like an example was ATVI. I went long ATVI back in September. I'm still long. And the market during some of that time was dropping. ATVI hit a target fairly quickly, and the rest of it is put it away, who cares? And you kind of build that long-term portfolio. A unique stock is one that is, it is a market stock, but it's showing nice strength. It's something that's gone on its own page because of its uniqueness or whatever, because of just a superior chart pattern. I don't have a chart here. I didn't do charts on all this stuff. The point here wasn't to show off the stuff from the letter, but let me pull up a chart from ATVI and kind of show you what I mean. And I'm doing this, I'm winging this. I hope this makes my point because I'm doing it from memory here. You got charts? All right, so here's a daily, here's a weekly. So I went long ATVI back in September. It's even right now, it's even off the chart here a little bit. Right there. That green bar day after the red bar day. See that right there? I went long there. So I consider this a unique stock, San Antonio, in that strategically, it was breaking across a long time weekly base down here. The whole analysis of this, it went through a gap. It refused to fill the gap. It held after the red bar, took out an area intraday. And this thing, I mean, look what this did from September to mid-September, and just compare that to the market. I mean, it really kind of had nothing to do with the market, right? See, when the market fell through here, this is a good example. This is exactly what I mean, right? I get in a position here, right? What if I traded? What if I here? Perfect. What if I traded the market, San Antonio? What if I traded the market? I got in here. Guess what? Looks like a stop out to me, doesn't it? Well, David, I leg into. I usually don't leg into a single stock over time. I usually, if I'm going to have five, six, seven stocks that I want to accumulate, I'll leg into the concept by taking one stock at a time. Okay. So here is an example where the market would have stopped me out. October 1st, boom, would have got plowed. And by the way, would it have been smart to have stopped? No. I mean, the market ended up working kind of, right? But look where this thing was there, right? It was still green. I hit a target and still green. So there's just a no-brainer, and that's what you look for. You kind of use the market as your guideline, and then you try and find these unique things the best that you can. Okay? I don't understand the question. You mean how much money do you need to justify having four positions instead of one position? It just kind of, I mean, with commissions being nothing these days, you don't really have to worry about it. There's no fixed fee, right? There's no fixed fee for being in a position. So you can spread out over multiple positions as much as you want to, whether you have a $5,000 account or a $500,000 account, correct? If that's the question you're asking, I'm not 100% sure. Does that make sense? Okay. Yeah, the only issue about that is fixed costs. There are no fixed costs anymore, really. Well, it's kind of what I'm saying in a way, Jerry. I mean, you can take that too far. I mean, diversity to the extreme, your goal then is only to break even, and that shouldn't be your goal, right? I don't believe in, but what I'm saying is I'm not diversifying to try and not lose. I'm diversifying so that on the way up, I'm getting the best of the best rather than just the market. All right, let me go on and wow. Well, we're not far from the end, but I have a lot to go over yet here. Um, yeah, so as you start moving, then you know your positions. Maybe you hit a target, you take some off the table. I have a slide coming up for that. But there is one thing I want you to remember, folks. There's one time you cannot be safe, and there's nothing you can do about this, and that is a disaster of some kind, right? Any normal, let me tell you, when markets make tops, there's three ways they do it. The most common way, the way that happened in 2008 and the way that happened in 1929, the way that happened in 2001, is completely predictable. It's the easiest, best thing in the world. There's a second way where we've never had a major top like this, but if you go back to, God, I don't know, the 80s or something, before my time, there were some times where you just kind of rounded out this little top. Those are more difficult. You still recognize it, but you don't necessarily, flip at the top like you'd like to. And then there's a third way, and that'll be through a disaster. And we've never seen that. We've never seen a disaster kill the market. Now, when these are dangerous is when the market's at a high. And I'm talking about like nuclear bombs going off. I'm talking about that type of thing. Our 9/11 was a disaster, but that disaster actually brought a bottom to the market. Reg, why do you keep typing that? You mean if North Korea drops a nuclear bomb? Yes. If North Korea dropped a nuclear bomb, then that would be serious, yes. But all the other crap doesn't matter. The whole conflict with Iran, the whole trade thing with China, none of that is in this category that will ever matter. The market will never drop because of routine bad news. None of this, okay? The market drops from exhaustion. It's always the case. Now, when you don't have exhaustion, now the only exception, like I said, is if we are up and we're up at the level where this could happen, we're up at a high level, and if some disaster happened, you could get caught. I mean, you could gap down one day 800 Dow points and you never return. That can happen. I'm just saying that's something. There's nobody can do anything about that. You just have to, get out, live with it, do whatever. But that's never happened. I mean, never. Even 9/11 was not really that because if you just hung on to 9/11, you were fine. 9/11, we had dropped for 9 months, and 9/11 we dropped 6 more weeks, and that was the bottom. So it really set the bottom, right? Yeah, well, Glenn, it's like buying insurance policies and everything. You can, but what can happen also is if you don't use the insurance and you keep buying options, what can happen? Well, let me just hit that real quick because it's a really tricky one, Glenn. I know theoretically it works, but one of the big funds went out of business doing this because well, there's no way to do it right. But you get way up here and you take out a cheap option. And what does a cheap option mean? It means that the market would have to drop a lot for you to get paid, right? So you pay X amount of money, right? And the market stops just short of payday, right? Yeah. But the cheaper it is, the more you're just covering the big disaster, right? So yeah, I guess if they're cheap enough and you're really covering the pure disaster, that's the way to do it because that's the equivalent of buying, like life insurance when you're 20 or whatever. So that's okay, yeah, pure disaster, right? But for a lot of people, let me just hit that because it is a big deal kind of. A lot of people feel that their answer to protect their long-term investment is to keep buying puts to protect. And what happens all the time is they buy a put to protect themselves and the market drops to the point that they don't get paid. In other words, here's where you start making money on the put. They spend all the money on the put, that goes in the garbage can, and then they never use it. And then you just keep buying the puts and you keep watering down your account. And if you don't go anywhere in your account, you start losing money because now you're buying insurance on something you don't need insurance for and you can't pay for it because you're not making money. So I'm just saying it's not that simple as an idea to protect your account to buy options. If it were that simple, everybody would do it. And like I said, there was a fund that went out of business trying to do that. All right, let me continue. What's this next slide about? Oh, and here's the other thing. You're comparing whatever results from a letter compared to what the market does. What about when the market falls? I can't ever guarantee it, but I don't lose money when the market drops. I mean, it would have to be a disaster gap down one day from which we never recovered or something. So I am always very sensitive to being short. And let me show you one of the ways that the goal of any fund is to try and lose less than the market. That's insane. Here's some other fun facts on the long-term trader letter. Number of letters sent. I was surprised there's this many, 100 letters exactly. That sounds like a lot, but a lot of these are just like quick little updates, like move the stop on this, move the stop on that. Because I try and, it's a long-term trader letter. I'm not trying to overwhelm people with information because that actually comes out to 2 a week. I can't believe it was that much. When I go back and look, I just can't believe it because I don't write 2 letters a week. But I think what it is, like I haven't written in the last month, I've only sent out 1 or 2. But there's times where things are hopping, we're getting in, getting out, and there may be a letter every day for a week or two just updating things. So that's how many there are. Number of positions taken, I took 44 positions last year. That averages about 1 a week. And again, don't freak out that it's really not that active because my trading style long term, I go very aggressive entries. And it's very not uncommon for me to take something and stop out in a couple days. Take something else, stop out, and boom, take something else, and boom, big winner. So it's kind of what I do. And so at turning points, you may see me kind of, just boom, taking a shot, boom, and then get it. So again, I guess I know that's what I've done. It's just looking back, it didn't seem like it was that many. However, biggest winner for the year, just for fun, closed. Serve, SERV, the last target of 3 targets is a 13 reward to risk, average 7.3. Open right now, Adobe, Last target is still open. It's about 15 Rs as of this afternoon, roughly, and that would be an average of 8 Rs. Adobe, just show this one off for you real quick. The Adobe chart, this strategy comes from the weekly chart right here. It was backed up by this, and by the way, this is exactly what I teach in class. Exactly what I teach in class is what I do. I'm combining a total of 4 time frames. Those of you in the seminar program, right? From the time frame above, it must agree or not conflict. The time frame below, and in this case, just like it says in the manual, I go down 2 time frames for an entry if it's a special type of entry. And that's exactly what I did here. From this weekly chart, I went all the way to the hourly chart for the entry on these. So you can see why they're a little aggressive, but they make decent money. So that's just an example of one of the trades that I'm currently. I have 5 longs and 1 short at the moment. J Blue is a short. So that's Adobe. That's a daily chart, weekly chart. Boom. Okay, and most important part of tonight, possibly. I think I talked about talking points. Good return. I talked about that. Who cares about what the return is if you don't make it? In other words, when your option is to take all your money and throw it in the market right now, I can't even do that. You know, I can't do it. So you can compare any benchmark you want, but it has to be a benchmark that you actually take, trade, and do. I know you have some questions up there, you guys. I'll go back and get them. You have to be comfortable in what you're doing. You have to be able to take and manage what you're doing. I see so many people talk about theoretical stuff, but they don't do it. They can't do it. Or they get in the market, it goes up 2% and they get out. And then they miss the whole move. Well, you're not comfortable, so you're not making money, right? You may justify it because it felt safe. I'm not sure what that means anymore even. I already talked about this. Do you really buy the market, hold for 30% gains? What is your downside if it doesn't work? Do you even have one? How do you sleep? Just a point that I was saying is if you don't do it the way I'm teaching you, I'm just telling you from experience and from working with people, it's very difficult because what if you just jump in with everything, what is your stop? Where do you get out? I know you're going to pick one on the chart, but you're really going to follow it. And what happens to most people is they no sooner stop out than it's time to get back in again. And I want to show you one last thing here. This is kind of the last educational slide here. And that is this. And this is, again, a very theoretical thing. This is long, short. This is just a caricature. Market moving up, right? So you get in at some point, right? And you're mostly long, right? You have a nice rally, you sell some stuff. Okay? You have the next pullback, the trend's continuing, all the time frames look good, technically everything looks good. You could care less about news about China or anything else, everything looks good technically. You get in more long positions, right? Now on the way up here, you sold a couple, maybe you sold a couple of partials, you raised stops on a couple things, you get to buy more positions. Does this make sense what I'm showing you guys? 1, 2, 3, does it make sense? This is how you get into the market and hold it for weeks, months, years, whatever it may be. You rally again, you sell some of the longs, and maybe at some point you start to say, boy, I'm not sure if we're getting near a top. I'm going to pick up a couple of shorts. Now maybe those are throwaway shorts. Maybe those are throwaway shorts mean, you're putting one in the portfolio just in case. But maybe they're shorts that don't stop out on you, like my J Blue right now. Turns out you're wrong and you rally some more. So you rally some more, you sell some longs. You get to a point where you're saying, you know what, my technical expertise of the market is that I think this is the market top. And don't forget, when I say market top, it doesn't mean necessarily the 2-decade top. I just mean there are a lot of times where we rally to areas in a weekly chart. Like I've shorted big time a couple times over the last 2 years. So maybe you hit one of those areas and now you sell significant parts of your longs, bring up the stops, and now you throw in a couple shorts. You see what I'm saying, everybody? And with this type of a rollover mentality, do you understand how you're never really in trouble? You can never get in trouble. You go way up here into the stratosphere and you will all of a sudden have a crash, you're still making money, or you're not losing money, or you're happy about the money you made, one of the three. It's hard to, I guess, to explain all this perfectly. And again, I'm not sure if I'm boring you or if I'm over your head on this, but that is the concept. I want to remind you all, and every little time I talk to you, I want to remind you about this stool slide is going to be in here every time you see me in 2020. Because when you go to learn stuff, having superior technical understanding is key. But in addition to that, you need the correct psychology and experience. You need math and probabilities. You need to learn all these things. That's what I teach. Coming up Friday, Introduction to Mastering Technical Analysis. You'll get an invite to that. Be there for that. Saturday starts a seminar program for those of you who are paying to be in that. If you need money to day trade, I have been referring people to a perfect place, I believe. There have been several people there. I've known the place for years, and safe money, 10 to 1 ratio, 95% payout. Just email me if you have questions about that, okay? Now, let me go back. Oh, yeah, gosh, the market letter. You see, Joe, I didn't even. I should be like showing you stuff about the market letter, right? How wonderful it is. And let me just give you the link to it. I didn't even put a slide. See, I didn't even put a slide in here about it, right? Figure, hey, if you guys like it, you'll figure it out. It's like I don't even know how much it is. It is if you get it all alone. There's a for the letter. It is a big discount annually. It's 187 a month or 1500 a year approximately. And here's all the information on it. There is a great little summary of it if you want to read all about it. This is on the services page at the DTS site, but here it is. So thanks for asking. I totally forgot. There you go. Chuck, because of where we are in the market, you're asking about the duration of the trades. Everything I've been doing has been inside of a year. Yeah, I mean, even the longer trades for me have been 7, 6, 7, 8 months. That isn't always the case, but we are. If you look at the market where we were before 3 months ago, it was kind of choppy. I was short, long, so I was kind of flipping back and forth. So there wasn't anything from the letter that was held more than a year. And even now, even though we're in this big rally, it's 2 or 3 months, and this is not going to last more than another, whatever. So these things can go on longer than that, but the market environment we're in this last year, nothing has. And rightly so. There's nothing. Who am I talking to? There's nothing, Chuck, that would have survived. I mean, I don't think there's anything that I did long or short that it was not correct to end it at 6 or 9 months because that was the maximum move. Okay? Oh, swing trading. Well, Peter, you missed the beginning. I don't swing trade myself. I day trade and I long-term trade. Couple of reasons. Number one, if I do any holding overnight, it revolves around an intraday position. I don't think that swing trading from daily charts, I think is a deadly thing to try and do. Now, I know people talk about it, they promote it. A lot of people promote it because people who can't day trade and they want to, if they're your broker or they're whatever, they say, oh, just swing trade from home while you're working. It's very hard to do. The daily charts are not properly set to do swing trading. The risk reward is not good. The volatility in the morning is a problem. As a matter of fact, I even have a video on the website talking about the problems of swing trading if you work another job and doing it from daily charts. I recommend you don't do it. It's hard. You can do it. I mean, you just follow what it is. But I don't do swing trades from daily charts. I have nothing to show you. I don't do any. Okay. Now, some of these trades I do, Peter, I actually enter some of these on hourly charts. And, they could be held for whatever duration you want. Jackson, to start, just you mean like investing? You can you can get a Robinhood app and start with I think $20. You don't need any minimum. Today, with no minimums and no commissions, you can start. Oh, for the letter. Well, here's where you'd want to go back to this slide. It depends. If you assume you're making zero, I did a little math worksheet here for you. Assume like you're making zero. $10,000 if the letter again were to do whatever percentage you pay 1,500 for the letter, you're making whatever money, right? So it's just a simple math question. It depends what you're making now. If you're making 20% now or 15% now, then it doesn't pay. But if you're not making money or you just don't want to do it because you're struggling with it, then it would probably make a lot of sense. I should leave that slide. Okay. Yeah, just an objective question. And I put in there a note that, a lot of people, even though objectively it may make sense, a lot of people have a hard time doing that because they either want to learn it through trial and error or there's just a little bit of pride or stubbornness that says, I can do this. And I get that, and that's fine. But just at some point be objective. If you've been trying and you're not getting better and you're not learning, you're not doing anything to learn other than trial and error, Well, maybe, focus on whatever you do primarily for a living and let somebody else make these picks for you. Yeah, Dave, that's a great question. There are some issues about handling everything when you're in totally in an IRA. So this would suppose to be able to do this, you would have to have, besides your IRA, another account where you could do the shorting in, number one, or number two, you do alternate things to handle that. Now, there are some things you can do to be short. You wouldn't necessarily be able to duplicate every position, but you can be short the market in an IRA. You can do some options things in an IRA. And matter of fact, I actually had somebody else asked me about this, and just to help them out, I found what I thought was a pretty on point article. Oh, here it is. I got it. But right, that's what I'm saying. You can short, but I'm saying is you a specific stock play that I do in most typical IRAs, it's not that you can't short, it's you can't go on margin, and by definition, a short you have to go on margin. So you can't short a stock in the typical IRA. So you'd have to do the shorting in another account, or translate the short position and say, okay, Paul's bias was on the market was this, so I'll take some market short. But also, beyond the market, you can use the ETFs to go into any sector you want to, and you can short any sector, anywhere across the board. There's hundreds and hundreds of ETFs, and most every ETF for every sector has a short ETF, and by going long the short ETF, it satisfies the requirements of the IRA to be long, but yet you're really short. Here's an article you might enjoy. I read this. I don't have any problem with this article. It's from Motley Fool. I think it's all good stuff they talk about in here. Okay. There are more people that are interested in long term than they are in day trading for sure, because not everybody's available during the day. And for those of you that are interested in day trading, I really think that the way to learn it is not wait until you don't have a job, but rather if you have a type of position where you are free a day or two a week, or if you work at home, or you can schedule things in the afternoon, if you can have a couple mornings free a week, I think it's worth it to start dipping your toe into day trading. And the issue is if your money's all long term, you can get into a prop account where you can start with $5,000 and then $50,000 of buying power as a day trader, and you can have it open in a couple days. All right. Thanks, guys. All right. Have a good one. We'll see you on Friday. Those of you in the room, we'll see you tomorrow. Have a good night.